what it takes to be a successful fund manager.
That is the role of a fund manager.
Very interesting to know the kind of team sport behind managing these funds.
So that is a good question actually.
Our investors have got phenomenal returns.
Growth is a given.
At the peak of its performance,
The intention to share wealth with shareholders. Everything is about people in every part of your life. Same applies to the fund that I manage. Over the last 6 years, fortunately, we have not come to that situation.
hi, we have with us Mr. Chandraprakash Padiyar, who is the Senior Fund Manager of Tata Asset Management Company. He currently manages two successful schemes, Tata Large and Mid Cap and Small Cap Fund. Collectively, both the funds put together, 15,000 crores is the asset under management. And he is able to run these schemes very successfully over 5+ years. And we are going to hear from Chandraprakash today how this fund management is done and what are the thought process and what as investor we need to do to benefit from the successful funds where we have invested. Great to have you with us today, and I would like to begin asking you that, Tata Small Cap did extremely well. That at the peak of its performance, you stopped accepting lump sum money. Can you tell us what is the reason behind not accepting money into such a successful fund?
So Tata Small Cap Fund, as you rightly said, we started in 2018, and by 2023, we had delivered fairly decent performance for investors. But once you deliver very good performance for a long period of time, there is this, and there was this momentum in small cap as a category overall in the market, and we were beneficiaries at that point in time in 2023 of very large positive flows in our fund month after month. Small cap as a category in the market is a segment where liquidity profile of stocks that you want to buy, where risk reward is favorable, and we've done our research and we want to hold for the long term. Liquidity profile is generally relatively illiquid, and when you get large sums of money in a short period of time, in our opinion, it is not advisable to go in and buy aggressively in the market, because then you forego your risk reward for the long term. So between, let's say, March of 2023 and June of 2023, which is when we shut down the lump sum window, our cash levels in the fund had gone from 5-6% on an, or let's say 8-9% on an average, to more like 17%. So we were choosing to go slow in deployment. And the first thing that I want to highlight also is that as an investment style or as an investment philosophy, at Tata Mutual Fund, our philosophy is growth at reasonable price. We would want to buy businesses where growth is sustainable at a strong pace over long periods of time with free cash generation, but also you buy a business where valuations are on your side, which means that in your investment horizon, there is room for re-rating in valuations for a business. Now, if you buy businesses, so which means that your risk reward needs to be at least 2:1, 3:1 or higher. When you get so much money in a short period of time, practically small caps being illiquid in nature, it disturbs your risk reward in the short term. So to take care of that issue, and as I said, our cash levels went to very high levels. So we chose to shut down the lump sum window and continued the SIP STP window for even now it is continuing. So after June, July, we've gone back to less than, in fact, for some point in time in a couple of months back, our cash levels had gone to as low as 4% and lower. So we took this time, or we took advantage of this period when we shut down the lump sum window in June. Between June and March of 2024, we reshuffled the portfolio because new money had come. So we had to deploy incrementally. So we booked profits in existing names, we bought new stocks. In fact, between October of 2023 and March, April of 2024, close to 60% plus of small cap portfolio, Tata Small Cap Fund portfolio, was churned. So we made a large change in the portfolio, keeping in mind the next 3-4 year viewpoint, because we don't churn so much on a long term basis. So the point that I want to make is that it was more because of the speed with which the money was coming that we had to shut down the lump sum window. We continue to be optimistic on the small cap space, and we believe that there is enough and more opportunity for investors to make reasonable returns over a long period of time.
You mentioned that you used this period when you are not accepting lump sum money to ensure that the portfolio is rebalanced. And to sum it up, I can say that that kind of protected existing investors' return, plus now that gave you the opportunity to buy completely new set of opportunities into the portfolio. So that kind of ensures the next 5-6 years the returns are kind of taken care.
That is the idea, yes. That was precisely our view, that if you keep taking large sums of money in small cap category in short periods of time, then it disturbs risk reward for existing investors. We did not want to do that. So today, yes, in the last, as I was saying, between October, November 2023 and March, April 24, we've been able to reshuffle our portfolio, and the risk reward is once again looking good. So we are hopeful to deliver good performance.
Great. Now, when you're taking these kind of decisions at the fund level, is it purely the fund manager's decision, or do you have a team which collectively where you discuss, and then even though you take the final call for the fund, I believe, but what is the process followed, when to stop accepting the money and when to exit from the sector, all of that, is there a team working behind it, or how is this done?
So everything is always a team effort. I don't think any one person can make such a large difference for a long period of time. Similarly, in Tata Mutual Fund, we have a full process and full team structure. Starts with our CEO, then CIO, senior fund manager, then normal funds, and then junior fund managers, and assistant fund managers, and then research analysts. So we are from an investment team perspective, we are a 14-member team today. And all of us, the structure process that we follow is that any business that has to be, so we have an investment universe concept in Tata Mutual Fund, where first of all it starts from the investment philosophy. As I said, our investment philosophy is growth at reasonable price. So any business that we buy or sell in the portfolio has to meet our investment philosophy. Secondly, in the investment universe, what we do is on a daily basis we would go and meet businesses, all 14 of us, and we would come back in our office and discuss and debate in detail the positives, the pluses and minuses of that business and that team who's managing that business. And at the end of the day, once you discuss in detail, we create a Excel model in terms of what we expect from that company in terms of earnings delivery over the foreseeable future, which is typically in our case 2 to 3 years and longer, since we are long-term investors. And we also create a proper Word document in terms of explaining investment rationale for each company that we buy at the time of creating, or let's say discussing a particular company. Once the merits of each company is discussed and debated, and once it is then put up for approval to the CIO. So actually the CIO is the key authority who decides whether to approve a particular business to be part of investment universe or not, or reject it. Once it is discussed and approved by the CIO, this business becomes a part of the investment universe. And investment universe is the document, or let's say a list of companies for us, for all fund managers to then choose companies from. So consistently, so for example, I remember this when I joined Tata Asset Management in 2018, the investment universe was something like approximately 200 companies to choose from. Today we are approximately 400 companies to choose from. So over the years we have expanded the investment universe, and every fund manager has the authority and responsibility to choose based on the features of the specific fund that he or she manages, to choose stocks out of the investment universe and allocate weightages to the portfolio as per the risk reward that he or she believes or has to deliver over the next 2, 3, 4 years or long term. Now your second part of the question is, when you stop taking money, who decides? So it's the risk reward. First of all, it has to be put up by the fund manager himself. So in this case, Tata Small Cap Fund perspective, it was my responsibility to approach the top management team, which is starting with CIO, then goes to the CEO, and CEO in turn will, if required, go to the trustees of the board. It was a collective decision, obviously initiated by the fund manager, which is me in this case. And I'm quite happy that the top management approved or agreed with the thought process that I had. And it helped us in generating good performance.
Very interesting to know the kind of team sport behind managing these funds. And you also mentioned that you're meeting the managements of the company. My question to you is, how important meeting the managements? And then what do you look at when you meet these managements? What 2 or 3 qualities that you look at in the management when you go for the meetings, and then what kind of impact it is going to have in managing those stocks in the portfolio?
So I think everything is about people in every part of your life, and same applies to the fund that I manage, and same applies to business people who we meet on a regular basis. And our approach is that, in fact, our policy is, our thought process internally is that any company that you want to buy or sell in your portfolio, meeting managements is very important. Understanding that thought process, what they want to achieve in their business. See, India is a growth economy. Everything will grow over a period of time. Every business will have opportunities to grow. Having said this, we are custodians of wealth given by investors to us. And their expectations are that we perform for them in the short term, medium term, and long term. So short term is also important, medium term is also important, long term, as I said, everything will grow. But in the short term to medium term, many times it is the execution of management teams that becomes very important. Who is able to capture or exploit the opportunity that is presented to that business faster, with speed, and with free cash. See, in our business, I've learned the hard way. I've been in this business or managing money for 24 years now. And over the years, I've realized that balance sheet quality and cash flow generation by businesses is extremely important. Only growth is not important. So you have to see the quality of growth. And there lies the intention of the management and the thought process behind growing, which is very important. Not every business manager has an approach to grow with free cash. So I have to, or we as a team have to identify the right people behind a business who has the ability and the willingness to scale a business profitably with cash flows and with highest quality of integrity that they can. So corporate governance standards, the intention to share wealth with shareholders is also important. So all of those things, when we meet a management of a business, we are more looking for what does he think, that thought process, that body language, so it's not only about finding out what are they doing in their business, it's also about how do they believe they will reward shareholders over long periods of time. And so meeting management is in that sense very important, and we do it quite regularly.
Great. Now that you mentioned about how important meeting the fund managers, now you yourself have come with 23 years of experience being an analyst and equity research person to a fund manager. Similarly, your colleagues also come with a greater amount of experience. There can be always biases, and as a Tata Mutual Fund house, you're managing close to 1,60,000 crore. So how do you stop these biases coming in, and if there is a difference of opinion about the same company among your fund managers, so how do you manage that and come to a conclusion, this is how we should go ahead and form a view about this particular company, whether to add it into your investable universe or not?
So that is a good question actually. That is the role of a fund manager. In fact, that is exactly what my role as a fund manager is. In fact, you're very right that we are human beings after all. There are emotions that come in, there are biases that come in, and as I said, investors expect relative good performance, including, so one is absolute performance, which is absolute return for investors. But investors have an option to invest in Tata Mutual Fund and other mutual funds as well. So there is a relative game as well. So in short periods of time, medium term, investors do expect us to deliver relatively better performance to benchmark index, to peers at all times. To do that, you have to try and avoid biases, emotions in a portfolio. So the way we try and take care of it is that, let's say, so the two funds that you mentioned I manage, Tata Small Cap Fund, Tata Large and Mid Cap Fund. So there is, over the years, this is through my experience, it can be different for different fund managers. But the way I approach this subject is that I have realized over the last 24 years managing money is that up to a level of underperformance by some select company in the portfolio is okay to manage with, till the time a majority of part of your portfolio is doing well. So I'll give you numbers. Internally, the way I deal with this subject is that up to 20% of the portfolio, till the time it is underperforming for me or not delivering the right performance as I expected, I am still okay because 80% is delivering performance. So I can give that particular part of the portfolio or businesses that I buy some more time to deliver. But the moment this proportion of underperforming part of the portfolio crosses 25-30%, there is no one number, but around those levels, it starts impacting the overall performance. And that is when, so I track, rather than tracking individual companies which are not doing well, I club it in a full piece of part of the portfolio which is not doing well and track this proportion of the portfolio. The moment it crosses 25-30%, as I said, as a rule, internal rule, my personal rule, I have decided that I will sell minimum 50% of the portfolio at that time. So emotions are off. It creates discipline. Over the last 6 years, fortunately, we have not come to that situation. Being in Tata Mutual Fund since last 6 years, this is my 6th year managing money here. We have not come across that situation. But as a policy subject, or as a thought process, I intend to follow this, and that will hopefully help me in taking care of emotion and risks that can come by, or biasness that can come by.
I'm glad that you touched upon that performance parameter, the 20% of the portfolio approximately. Now I want to preempt that part as an investor in the fund. Now what is happening today is that people go to internet and look for the best performing fund in that respective category, and then they pick the number 1 or number 2, number 3. I want to ask you, can a fund remain number 1 forever? And if I had invested in small cap and then there is a dip in the performance and or the ranking, when should I decide to exit? Or what is the timeline one should stay put in the fund to get the maximum compounding or the benefit of these strategies which you put into the fund which generates phenomenal return?
So first of all, I would admit that there is no right or wrong answer to this. We are all trying to learn what is the best way to allocate capital towards individual fund houses or fund managers. Having said this, my experience tells me, and you would know this since you do this daily in and out, is that there is no fund manager in this industry or abroad who has been able to be in the top rank or top 2-3 ranks consistently beyond 3 years. It's actually practically not possible, because every fund house or every fund manager manages money with a philosophy in mind. For example, I mentioned Tata Mutual Fund, our philosophy is growth at reasonable price. Now we look for growth, but we also look for reasonable price, which is valuations. And we, over a period of time, we want valuations to move higher from our starting point. For that, this company needs to deliver earnings delivery year after year, quarter after quarter. And if that company delivers, so we are betting on management teams to deliver something to us. And if earnings come, then over a period of time, re-rating will happen. Now, this is a 3-4 year process for one portfolio that we create. We are buying businesses. My peer is buying some other business. Let's say there are fund houses in the industry today which are value oriented. There are fund houses which are only momentum growth oriented. Now these markets, equity markets, different point in time will have different flavor. There are times when value performs, there are times when momentum performs, there are times when growth at reasonable price performs. You have to stick to your style, and hence there are 6 cycles where, and sometimes index performs, sometimes fund managers don't perform relatively. So there are times when, so we have this saying in our market that every dog has his day, which is that every fund manager will have its own time. The thought process, philosophy comes back in cycles. In cycles it comes. It is just that what we have to ensure is that we are sticking to our philosophy, our style, and we don't make mistakes in picking businesses and management teams. Till the time you are doing right due diligence and not making mistakes, which means that you are not losing permanent capital by buying leverage companies or buying entrepreneurs or management teams who disregard corporate governance standards. If we are not making mistakes, I think our performance over a period of time will pick up again. As what we all aspire for is, in fact, we don't even aspire for being in the top 1, 2, 3 ranks. As a fund house, our thought process is that if we can be in top 2 quartiles, let's say there are 26 funds that I compete with in all my both my funds in each of the category. Now within that 26, if you divide by 4, so 6 is the top quartile, the first 6 is top quartile, the next 6 is the second quartile. I need to be in the top 12 rank consistently over long periods of time. Till the time both my funds are in the top 2 quartiles, I think I would have done a good job. Sustaining your performance in top 2 quartile is possible. Sustaining in the top 1, 2 rank is not possible consistently. And the good news is that both my funds and many funds in Tata Mutual Fund today are sustaining in the top 2 quartiles over a long period of time.
Great. It has a very important message for investors. Funds will go through its own cycles, and don't look for always number 1, number 2, number 3. As long as they're in the top quartile, you should be comfortable. Now that brings me to another question. How many years one should stay put in a fund typically? Because the definition changes person to person. Some may think long term is 3 years, some may think long term is 5 years, some may even think long term is 1 year. So what is long term according to you, and how many years one should stay invested in a fund?
So again, it depends on, actually the answer is different, or let me rephrase the question. It actually starts from asset allocation. You all, in fact, you are in this business, you do this day in, day out. It depends on the age profile of a person, an investor. It depends on savings that he or she has. It depends on the ability and the willingness to take risk. That is important. So it starts from there. And once you have done that due diligence of who that person is, how he or she behaves in good times, bad times, because I've seen in various time periods. In fact, in my previous organization, since I used to manage money for HNI clients directly, I used to interact with them directly. I remember we used to fill up a form with them in terms of understanding their risk profile and ability and willingness. And invariably, all investors used to write that I am okay with taking high risk, but I want high return. Invariably, they used to do this. So they used to tell us ability is also high, willingness is also high. But when bad times came, every person changes. Or most people, I have realized, changes. So it is important for the investor to understand himself or herself, what he or she is, or how will they behave, what kind of capital they are putting in equity markets. Now coming to the question on how much time to give. I think my own experience is that, in fact, right from post, I did my BCom, I did my training Aditya Birla Mutual Fund at that time, before my MBA. And I was a trainee in a branch office in Pune, and I used to just distribute forms from one location to the other. So that was my job. But the stipend that I got, I invested in the fund of that mutual fund at that time. And then I forgot about it. And today it's grown to a very handsome size. What I'm trying to say is that the longer you are, you should, first of all, you should invest in equities only to an extent, the amount that you can forget. Buy and hold for the long term is quite, for example, Indian markets sitting today, last 5 years, 10 years, 15 years, 20 years. surprisingly has been extremely consistent at 14 to 15% CAGR, compounded. And compounding makes a lot of wealth for investors. So I think the longer you can hold equity, so invest only that much which you can hold for a longer period of time. But if you are invested and if you can buy and hold for long, I think it makes sense. So I don't think there is one set period for equity investing, but the longer the better.
Yes, so I can happily tell our investors that the longer you stay, the better it is because of power of compounding. And one should get the asset allocation right and then stick to it till the time when they need their money for achieving the goal and fulfill their goals, maybe the children education, buying a property. For that time they can consider getting that fruits of it and using it to fulfill their life goals. But otherwise one should stay invested for long duration. That brings me to another question. There are times, you also touched upon previously, that sometimes the index performs and the active fund management underperforms. Now that sparks a lot of debate. Is the fund managers are adding value or not? It's better to buy an index and sleep on it, and over a period of time the index will do better, and these debates keep coming now and then. So what is your view about active fund management or buying index and then just leaving it? What is your thought? Of course you're an active fund manager, so what would you tell the investors when it comes to debate about active and passive?
So I'm biased. I am pro active management. Having said this, if you look at data, you will realize that everything has a cycle. Active has a cycle, passive has a cycle of its own. What I mean by that is that, see, there is this set of, let's say, BSE Sensex as an example. There are 30 stocks in that index. Now, generally speaking, indices tend to also look at very long term. So they also don't churn the index composition very often. And what happens is that if, let's say, within the index, if there are 5 companies which are doing a great job, their stock prices appreciates and the weightage of those 5 companies appreciates significantly. So over time, success of those 5 companies mean that the index also gets skewed. And success leads to the next round of, when you peak on that performance, it leads to churn in the index not from change in the stock composition, but from the next round of stocks then start performing because of cycle peaking and earnings peaking. And so you do get a period where the same index, same composition, but different stock with a different weightage, it starts behaving in a very different manner. Similarly, in our portfolio, let's say we also look at long term. The active management, the way it helps is that we don't need to be with this. Let's say when the stock, for us, if 5 stocks are performing, if they keep rising, we can choose to trim or book profits. Don't exit fully, but we can allow, or we can let it not go up significantly as a proportion of the fund, and try and avoid those cycles till so long as we can. In my opinion, I think passive money performs, or let's say index funds perform for a period of time whenever there is a very large amount of flows chasing limited number of stocks. Or like 2023, the previous year, calendar year, where there is an extreme broad-based rally, where stock selection doesn't matter, number of stocks matter. For example, if you were to do an analysis of mutual funds for calendar year 2023 across categories, large cap, mid cap, large and mid cap, small cap, flexi cap, you look at any category, you will realize that on an average, funds which are having more number of stocks in their portfolio did better than funds which had less number of stocks. It had nothing to do with stock selection. It was purely the market, which was an extreme broad-based rally, where stock selection was not important. Being in the market with as many stocks was more important. Now, this is something that doesn't recur very often. So this cycle, last 1-2 years, I think index funds have done well on a relative basis. And that does bring that debate, as you are rightly saying. And whenever markets become normal, and though you've not asked me this, but I think we are reaching that phase where market returns will normalize towards lower levels. Whenever returns become normal and momentum goes away, you should see stock selection coming back in the market. And it is not a broad-based rally, which means that active managers like us will play an important role in the foreseeable future, which is the next 1 to 3 years. So it's a cycle, as I said. I think these phases come and go. So the moral of the story, or the answer there, is that both have a role to play. Some places, in some parts of the market, index funds can play a better role. But there is also a large part of the market where active managers continue to play a very important role. So as I again saying, asset allocation is important. An investor can allocate to passive and active both ways and get the best out of them over a period of time.
Chandraprakash, when do you decide to sell a stock from any of your funds?
So there are various ways, but let's say when you book profits, let's say when we buy a business, the idea is to make money, right? So if a company is delivering good earning growth consistently for a long period of time with free cash generation, and over a period of time, if market re-rates a particular business, then you do see fairly large appreciation in that business over a long period of time. If we believe incremental risk reward is not so favorable, then ideally I would want to book profits and look for alternative ideas. So that's the first way of, and the ideal way of, booking profits and churn or sell a stock. The second is that at all times we are always reviewing what we own in the portfolio and what we are missing out of the portfolio. There are list of companies listed in the stock exchanges which are also doing a good job. So we are always on the review part. We are reviewing, are we missing something in my portfolio compared to what I already own in the portfolio. So on a relative basis, we are reviewing and discussing and seeing what needs to be done. In case we find an alternative idea where we find a company which we can buy in the portfolio and replace it with my existing stock, that creates some amount of churn. And lastly, if there is a business that I bought in the portfolio which does not deliver to our expectations, then we have to sell and create space for some other thing, some other business for the portfolio. So that's more like a stop loss. Ideally, we would not want to have mistakes in my portfolio, but the third category is more like mistake that we would have bought which did not deliver as per our expectation. And that's the third way of, that's a forced selling in that sense in the portfolio.
Asked about timing the market, and you touched upon it. Now, many a times what happens, we as investors, a common man looks at many of these business channels and this social media and all of it, try to take a business decision based, investment decisions based on these influences. So I want to personally ask you, how much time do you spend watching business channels or social media, and does it really help you to take that final call in buying the stock in your portfolio?
So we are fundamental investors, and we strongly believe that equity investing is all about discounting future cash flows. What is important to understand in this line is that it is about the future. So our job is to identify trends which can happen in the future. And hence we are paid to look at history, look at what is happening today and what can pan out in the future. So to that extent, we consume all kinds of media, whether it's print media, TV media, social media, all kinds of media. Having said this, media tells you what is happening today. We also need to see what has happened in the past and what can happen in the future. And that comes more from reading and understanding various subjects and trying to get domain expertise in a particular subject, which is why we create a team. So as I said, at Tata Mutual Fund, we are 14 members in the investment team. All of us have been brought to to be a part of that team because we bring some skill set to the team. I have some domain expertise which I add as to the team, and my other colleagues manage something or have some specific quality in them which adds to the overall team strength. So as a team, we are in that sense, to come to your question, yes, we consume media, but that's more to be abreast with what is happening today. But that's not a fairly large part of what we do. That's more to help us being in the know of what is happening today.
We just had a major event, election outcome in our country. And I think now again, November, US election will come. In between, some state elections will come. So I think next 5 years, again, we'll have another election. So how much weightage do you give for these political scenarios and the elections and the outcome when you are making your investment decisions for your funds?
So it matters over a long period of time. Leadership matters in everything. So if you have a good leader, good political system running, good economic policy continuing, then it helps in the overall ecosystem. Having said this, our job is to buy businesses, and our job is to bet on people running those businesses. So what we do is to identify management teams which can grow over long periods of time in spite of the environment. If the environment is good, everybody will be able to grow. But suppose for some reason, either political or some global geopolitical reason, business environment gets disrupted, we would expect that the management team does something in that business so that they can grow. And anyways, India is one, growing economy, and two, we are taking a larger share of global pie. So for example, when I started my career in 2000, India is, in terms of global share of GDP, was in somewhere around 1.5%. FY24 we were 3.6%, and IMF predicts that in the next 3-4 years we will be 4.5 to 5%. So our share in the global GDP is also growing, and we are taking market share. As Prime Minister Modi put it some years back, Atmanirbhar Bharat, Make in India, these are new concepts, or let's say new themes, where the government of the day is pushing manufacturing in India. But the reason why they are able to push it is because economics has started working in India's favor. Cost structure for Indian companies are today either at par or better in some cases relative to the manufacturing hub of the world today, which is China. So circumstances are such, and this typically happens over time. Our per capita income is increasing. We are somewhere close to $2,500 per capita GDP, and this will move towards $5,000. So all I'm saying is that growth is a given. Who delivers that growth is what we have to. This is our job. So to come to your question, I think politics matter. Politicians matter a lot. Policies, what they adopt, also matters a lot in the long term. But even then, our job as fund managers is to identify management teams who can work with or without policy support.
Now, I want to ask you another question where we touched about the qualities for the managements which are running the companies. I want to ask you what it takes to be a successful fund manager. Let's say 2-3 qualities to be a successful fund manager.
I think there are no set answers there. I would assume, and there are various ways of managing money actually. There are some fund managers who I know of do a good job in quantitative fund management, which is looking at statistical data and delivering returns. There are fund managers like us who are pure fundamental driven, earnings driven, betting on management teams and who can deliver profit growth over a long period of time, cash flow growth, and that's what we do. And there are some fund managers who look at only trends, charts, and managing. So there is no right or wrong there. I think everybody has a role to play. But I have seen that over long periods of time, if you see, I've I've learned one thing in the last 24 years is that you need, over a period of time, you don't need too many companies of your portfolio to do very well. It's 80-20 rule applies everywhere. In a portfolio, 20% of your portfolio will deliver maximum amount of your returns. If you get that right, then you can do a great job for your investors over a period of time. So I think to be a successful fund manager, I aspire to bet on some management teams where I can buy and hold for a long period of time, where compounding happens at a fast pace and wealth effect comes in and creates a lot of wealth for my investors. But inherent in this line that I just said is patience. This requires conviction, this requires patience, and if my investors can give me that time, and if I can generate long returns over a long period of time, I think every fund manager can succeed. So in that sense, the quality of investors is also important. If my investors decide that they will not give me more than 2 years to deliver performance, then whether I have good ideas or bad ideas doesn't matter. So investors also need to look at long term. So whenever I go to any investor, and I come to you as well through your investors, I request that give us at least minimum 5 years, longer the better, to deliver performance, and we think that we have enough ideas to deliver decent performance.
Thank you, Chandraprakash. You covered it not only for fund managers, what it takes to be a successful fund manager, also what it requires to be a successful investor. You summed it up both nicely in this piece. Chandraprakash, you manage large and mid cap and small cap. Right? You kind of cover large cap, mid cap and small cap. But when it comes to funds, large and mid cap managed independently and small cap managed independently. So how one should differentiate while investing, even though it's the same fund manager, how the approaches changes in two different funds and two different mandates?
So from a fund manager perspective, it doesn't change. Meaning that both funds, we are betting on management teams running their business. We are betting on that business growing over long periods of time with free cash flow, and we are betting on re-rating of valuations. So the thought process, philosophy of investing remains the same. So from my perspective, nothing changes. Having said this, from an investor perspective, things change, things do change. Meaning that at any given point in time, different market caps or different market segments trade at different valuation levels. So for example, over the last 4-5 years, a mid-cap segment of the market has got re-rated very sharply. Small caps have also got re-rated, but there is maybe still some room to go higher. Large caps though have also re-rated, but they are far lesser from a return perspective, which means that on a relative basis, valuation differences are certainly there. For example, when you look at large caps today, within large caps, financials, which is a larger part of large caps, have given far lower returns, and they trade at below average valuations today. So from an investor perspective, if I have to look at the medium to long term or the foreseeable future, I would say probably large caps have a better risk reward relative to pure mid caps today. So in that sense, since a large and mid cap would be a good way to invest rather than doing a pure mid cap investing, because it balances both portfolios. And small cap is a totally small cap dedicated fund. And as I was saying, today those small caps have got re-rated, but maybe there is, given the business profile, and a large part of small caps, by the way, is manufacturing focused businesses. And I was saying in the previous question that India has a fairly good chance in succeeding in manufacturing incrementally. So I think small caps may have some more room. So from an investor perspective, I would say that different point in time, different thought processes or funds make sense. And there I would in fact argue that the role of an advisor like you plays a very important role, because it is you who will help an investor do asset allocation. Different market levels, an investor needs to decide different market or funds or categories of funds to allocate over a period of time. So just to summarize, from a fund manager perspective, it's the same. We manage the same thought process. But from an investor perspective, different cycles, different market periods do impact their performances.
Chandraprakash, I must tell you, we've been biggest investors allocating our customers' capital at the time of launch of your small cap fund, and our investors have got phenomenal returns, and that created huge wealth for our investors, and they're happy today. But when you look at your fund performance as a fund manager, what gives you happiness? What keeps you coming to work for close to 25 years, day in, day out, being in the competitive field where every day your performance is judged, and sometimes it can be very stressful? What drives you to be a success, being a fund manager at Tata AMC?
So as I was saying, that 80-20 rule, that 20%, which is the re-rating that happens over a period of time, the moment you get it in your portfolio and the market appreciates that for you, and you see that re-rating in a business that you had bought and it goes up 5x, 10x, 20x over a period of time, that gives us the kick. That is what research is for us. So if we succeed in research and some of our names, the market appreciates and gives you that re-rating, I think that that is so satisfying. And in any ways, that helps my investors make fairly good returns. So I think we all aspire to have more and more part of a portfolio in those kind of names. So that's the journey, and that is all fund managers, all research analysts are always looking for that one golden egg which can create extra value for our investors. So that is what we live for, or we do every day.
Thank you, Chandraprakash, for that insightful interaction and helping our viewers to understand fund management better. Friends, we had this wonderful interaction with Chandraprakash Padiyar, who comes with 24 years of experience and is currently managing 15,000 crores under two of his schemes, Tata Large and Mid Cap and Tata Small Cap. In his interaction, he covered in detail the fund management process, risk management, and how wealth is created for unit holders following the process and a strong research. Indeed, it was an insightful and a wonderful interaction, and it was a pleasure to have him for all of you. Thank you so much for watching. See you again with another video.